Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamelin. Today we're diving into some timely and critical updates that could impact your mortgage and real estate decisions. Our first topic is the expected Bank of Canada rate cut next week and how it could affect your mortgage. The Canadian real estate landscape is brimming with hopes and fears about next week's Bank of Canada announcement. Several reasons have led experts to predict a quarter-point rate cut from the central bank on July 24th. This would mark the second cut in more than 4 years. After 6 long rate holds at 5% since July of last year, the first quarter-point cut was announced on June 5th. Recent inflation data from the United States shows promise for an interest rate cut in our southern neighbor, an effect that could trickle to Canada. Canadian inflation data for June showed that the Consumer Price Index rose only 2.7%, bringing the Bank of Canada closer to its 2% target. Last week, before Canada's Consumer Price Index data came out, Penelope Graham, a mortgage expert at ratehub.ca, told Daily Hive that the U.S. numbers give Canadians further reassurance that inflation is trending in the right direction. While the Bank of Canada has already made its first rate cut ahead of the U.S. Federal Reserve, the rising likelihood the American Central Bank will be in the position to do so soon will support further downward movement on rates in Canada without the risk of shocking our currency, she told Daily Hive in an email. Now, Graham is even more optimistic about a rate cut. The Bank of Canada has been clear that they're taking a data-dependent approach with their rate decisions, and the latest economic reports, such as June Consumer Price Index and consumer surveys, have cemented high expectations of another quarter-point cut on July 24th, she told us in an email on Thursday. Inflation easing in the United States has also opened the door for American rate cuts as early as September. This provides the Bank of Canada further assurance that it can continue to cut rates without risks to our currency or further sparking inflation. So how could the Bank of Canada rate cut affect your mortgage? Graham noted that bond markets have responded positively to inflation reports and growing optimism that central banks can cut rates. As a result, some lenders have lowered their fixed mortgage rates, and more discounts are likely should investor sentiment persist. Though highly awaited, the June 5th cut was not the biggest cause for celebration. Graham said its impact on housing markets has been minimal. The latest national real estate data indicates a short-term increase in sales in June. However, most buyers are clearly waiting for rates to lower further before returning to the market. This has prompted the Canadian Real Estate Association to revise its forecast for this year and next to account for slower buyer demand, she shared. If a 25 basis point decrease happens on Wednesday, here's what happens to a hypothetical homeowner. This homeowner put a 10% down payment on a $696,179 home, which is the Canadian Real Estate Association average for June prices, with a 5-year variable rate of 5.70% amortized over 25 years. The total mortgage amount is $645,984, and they have a monthly mortgage payment of $4,019. If the Bank of Canada announces a 25 basis point rate decrease, their variable mortgage rate will decrease to 5.45%, and their monthly payment will decrease to $3,924. This means that, per ratehub.ca's mortgage payment calculator, the homeowner will pay $95 less per month or $1,140 less per year on their mortgage payments. Who does a rate cut help? The expert added that mortgage rates are trending lower overall. She believes it's a great time to rate shop for those seeking pre-approval. This secures their rate for up to 120 days and protects them in case rates unexpectedly rise in the near future, the expert advised. While it may be tempting to get a variable mortgage rate when cuts seem likely, it's important to take your personal risk tolerance and financial situation into account. If we've learned anything from the Bank of Canada in the last few years, it's that nothing is certain when it comes to rate direction. Who does a rate cut hurt? Though most Canadians, especially mortgage borrowers and aspiring homeowners simply looking to buy for residential purposes, could reap the benefits of expected rate cuts, not everyone will welcome it with gleaming positivity. It's not a cheerful scenario for passive investors and savers whose returns fluctuate with Canada's prime rate. Graham commented that those with guaranteed income certificates and high-interest savings accounts will see their earnings lower should the Bank of Canada implement a cut this month. Let's move on to our next topic. Toronto condo sales are tanking, but asking prices aren't budging. This is a fascinating situation that has caught the attention of many in the real estate market. In June, condo sales in downtown Toronto fell by a staggering 29% year over year, according to data from the Toronto Regional Real Estate Board. Despite this significant drop in sales, prices have only declined by 0.9%. This discrepancy has led to an increase in inventory on the market, with new listings up by more than 12% year over year. Buyers now have a bounty of options to choose from. So, why aren't sellers adjusting their prices? Experts suggest that many sellers are over-leveraged and refusing to take a financial hit by listing their units for tens of thousands of dollars below what they bought it for. As a result, nearly half of the condos on the market have been listed for 30 days or more. This is a significant increase from the typical 18 days, indicating that sellers aren't meeting buyers' expectations. Tom Story, a sales representative with Royal LePage Signature Realty, pointed out that if you haven't sold in the first 35 to 40 days, the market is telling you they don't agree with where you've priced your property. He suggests that sellers then need to decide whether to take the property off the market or relist it at a more reasonable price. Only then will we see downward pressure on prices. Tim Sirianos, principal broker and owner of RE/MAX Ultimate Realty, added that many sellers are not participating in the necessary price adjustments, pegging their prices too high. On the other side, buyers are indecisive and lack urgency to make a decision. This combination leads to a lot of cancellations of listings, with sellers hoping to relist when market activity picks up again. Many sellers are banking on the fall season to see more buyers jump into the market, hoping to make a profit off the sale. However, realistically, these units might only make a profit for the seller sometime next year, when interest rates are lower and inventory is less. Story mentioned that the only way condo prices will go up is if the inventory in the market is cut in half and the Bank of Canada becomes more aggressive in its rate cut cycle. It's also worth noting that buyers who purchased during the pandemic price peak between 2020 and 2022 are now seeing the value of their units drop. Since the February 2022 price peak, Toronto condo prices have fallen by around $60,000. Sellers are understandably unwilling to drop their prices by that much, according to Jared Armstrong, a sales representative at Armstrong Team. Interestingly, a significant portion of these condos is investor-owned. Currently, 45.5% of condo units for sale are vacant, and 21.7% are tenanted, with only 31.1% being owner-occupied. This suggests that the majority of units for sale are likely investor-owned. Story noted that tenanted condos are very difficult to sell unless they are priced excessively low, and the buyer must be an end user willing to ask the tenant to leave the unit. Another hurdle is that many end users for condos are typically first-time home buyers who are being priced out of the market due to high interest rates and the stress test, which makes them qualify in the 7% range. Armstrong added that it would take multiple decreases from the Bank of Canada to make a difference for first-time buyers who are being stress tested at such a high rate. Downtown Toronto's condo market is experiencing a vicious feedback loop. The area is home to mostly small units that are largely investor-owned. However, fewer investors are currently in the market buying these small units to rent out, and there aren't many end users interested in pricey bachelor or one-bedroom units. On top of that, downtown's allure is fading as more people work remotely. Armstrong mentioned that downtown Toronto is particularly problematic right now, with a 20% vacancy rate in commercial real estate and office space. There's a large reduction in interest from people wanting to live downtown. Let's dive into another pressing issue in the real estate market: how pre-construction buyers are coping with lower appraisals at closing. Market volatility has had a huge impact, and this is a story that's becoming all too common. In recent years, property values across many Canadian markets have fluctuated dramatically. This unpredictability is presenting plenty of challenges for home buyers in the pre-construction sector. As the closing date nears, an appraiser may deem the home to be worth significantly less than the agreed mortgage value from 2 or more years ago. This can lead lenders to reduce the loan amount, leaving the buyer scrambling to make up the difference. In the Greater Toronto Area, where prices have been on an unpredictable ride amid the pandemic-era housing boom and subsequent cooldown, this problem is particularly pronounced. A mortgage broker based in the city, Mandeep Kanaka of Clear Trust Mortgages, told Canadian Mortgage Professional that this trend has been growing across various property types, from condos to detached homes. "I think those valuations have been very challenging just because rates have gone up," he said. "Someone in the neighborhood with a similar home sold for much cheaper has really thrown off the market, where now appraisers are not appraising that home for what the person has purchased it for, just because there's something similar selling for much cheaper." So, what can brokers advise clients whose appraisal comes in low? Unfortunately, the list of possible solutions is short. The borrower will need to come up with the extra money if there's a shortfall between the purchase price and appraised value. Even a short-term private loan isn't always available. When the borrower doesn't have another home to use as collateral for a private mortgage, those loan types are usually off the table. Even privates are very hesitant in going up to extreme high loan-to-values, Kanika said. If the valuation is not coming up, unfortunately what it leaves the borrower with is either they go back to the builder and try to negotiate a price or get an extension, or reach out to friends and family for an extra down payment. In Toronto's condo market, sales have plummeted over the last year, dropping by 29% in June compared with the same month in 2023. A flood of new inventory is likely to continue weighing down prices. Until the market shakes off some of the imbalance it's faced in recent years, this challenging outlook on appraisals is likely to continue, according to Kanika. He said that requesting family assistance is often one of the only avenues available to buyers whose appraisal comes up short. Many borrowers, he said, are not able to close, or they have to essentially resort to getting money from anyone, friends, family, to just help them save. And it's not a comfortable conversation on any front. Climbing interest rates have also had a big impact on market activity and the mortgage amount borrowers can qualify for. The advent of the COVID-19 pandemic saw rates plunge as the economy ground to a halt, and public health measures gripped the country, causing scores of would-be buyers to step off the sidelines and take advantage of those record-low borrowing costs. But as inflation spiked, hitting a 39-year high of 8.1% in the middle of 2022, the Bank of Canada embarked on an aggressive spate of rate hikes, moving its benchmark rate higher by 475 basis points and dramatically squeezing the purchasing power of many Canadians. The central bank finally cut rates in June, with further moves potentially on the way during the remainder of the year. A more balanced and normal market would be a welcome development, Kanika said, after the volatility of recent years. Many buyers during the pandemic were saying, "Okay, someone's bought for this, I'm going to go ahead and buy too," he said. And 2 years later, 3 years later, now the market's completely turned, and they never saw that coming. And neither did most people. We didn't know that the rates were going to go that high, and now in such a short period of time that they did increase, it has really had a rippling effect on the economy, especially with people who had purchased at that time. So it's unfortunate, but again, lessons learned. And I'm hoping that it's gotten us to a point where it'll stop a little bit of the speculation play in the market. Our final topic today is the introduction of stricter guidelines for mortgage broker licensing by the Financial Services Regulatory Authority of Ontario, or FSRA. This development is aimed at better protecting homebuyers and investors in Ontario. The FSRA has issued its final guidance to enhance the licensing standards for mortgage professionals. The guidelines are meant to ensure that current and aspiring mortgage agents and brokers are suitable to hold a license, ultimately protecting homebuyers and mortgage investors. So, what are the key changes? First, the FSRA will now provide clear guidance on how it evaluates the suitability of mortgage professionals. This includes assessing educational and technical qualifications, integrity, competence, and past and current conduct. The FSRA can now take regulatory actions if it determines that an applicant or a current licensee is not suitable. This could mean refusing, placing conditions on, revoking, or suspending a license. The guidance also emphasizes that brokerages and principal brokers are responsible for screening applicants and continuously monitoring their authorized licensees. Additionally, the updated guidance includes more references to provisions in the Mortgage Brokerages, Lenders and Administrators Act of 2006. This reinforces the legal framework governing mortgage professionals in Ontario. The FSRA has outlined some specific examples of conduct that would make a broker or agent unsuitable for licensing. These include criminal charges or convictions and breaches of laws or regulations administered by the FSRA or other regulatory bodies. The new guidelines became effective on July 15th and were developed with input from various stakeholders, including mortgage professionals, industry associations, and consumer advocacy groups. The process involved multiple consultations and feedback sessions to ensure that the final rules would effectively address the issues identified in the review. Stakeholder feedback indicated strong support for the FSRA's guidance to protect consumers and maintain integrity in the sector. Lauren Vandenberg, President and Chief Executive Officer of Mortgage Professionals Canada, expressed her support for the final guidelines, noting that they align closely with the association's own code of conduct, which emphasizes responsibility, due diligence, transparency, and honest services. Vandenberg stated, "By setting clear expectations, FSRA is reinforcing the high standards and ethical practices we uphold at Mortgage Professionals Canada. We believe these guidelines will significantly benefit both our members and consumers." These latest rules build on previous consumer protection frameworks. For instance, guidance released by the FSRA in June focused on ensuring mortgage agents and brokers meet high standards of professionalism and ethics. This includes knowing their clients and their financial situations, understanding the mortgage products they recommend, and ensuring that recommendations are suitable and properly documented. The introduction of these guidelines was driven by the rapid rise in interest rates following the pandemic and the impact on variable rate mortgages. The FSRA emphasized that clear guidelines on product suitability are essential to protect consumers in a volatile market, ensuring they receive mortgage products that are appropriate for their financial situations. As we wrap up this episode, it's clear that these new guidelines from the FSRA are a significant step toward enhancing consumer protection and maintaining the integrity of the mortgage industry in Ontario. If you're a current or aspiring mortgage professional, it's crucial to stay informed about these changes and ensure you meet the new standards. That concludes today's episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Thank you for joining us, and we'll catch you in the next episode. Stay informed and make well-informed decisions.